Hey everybody, welcome back to another session here in the Equity Trust Virtual Classroom. My name is John Bowens, and joining me today is Theresa Knower. She is the president of Equity 1031 Exchange. She has been in this business for nearly 20 years, and she has a ton of experience with respect to 1031 exchanges. So we're going to be answering a lot of the frequently asked questions that folks have about 1031 exchanges. Teresa, let's jump right into it. Can you describe for those that are brand new, what is a 1031 exchange and what can it mean for a real estate investor?
Absolutely. So a 1031 exchange is a section of the tax code that basically says if you sell investment or business use property and you purchase more investment or business use property of equal or greater value, you get to defer those taxes that would have otherwise applied. We're talking capital gains, depreciation recapture, particularly estate taxes as well. So it's not always just a matter of your capital gains. You could be looking at a tax savings of anywhere between 35 and 40% of the transaction as opposed to just standard capital gains tax rates. So this is going to benefit anyone that has rental properties, raw land that they're holding on to, or properties that they are maybe operating their business out of. So a lot of times we see people do exchanges where, their business is growing and they need to get a bigger space. So they sell their existing building and they buy a new, bigger one so that they can continue to grow and expand and not take a tax hit when they sell that building.
Now, Teresa, we work with a lot of folks here and we present to a lot of folks here in the virtual classroom that are using self-directed IRAs or self-directed 401ks or other tax-advantaged investment accounts. And so I know some folks can get confused between the difference between a 1031 exchange and a self-directed IRA. Can you speak to what are the differences? And then where could you potentially see an instance where a self-directed IRA real estate transaction can actually converge, if you will, with a 1031 exchange?
The difference between the two is that a 1031 exchange is typically done on property that's held outside of an IRA. There are some rare instances where a 1031 exchange would be applied to an IRA property. That's going to be when you have UBIT that applies. More often than not, we're talking about properties held entirely outside of an IRA. Both are strategies that are focused on tax deferral, tax savings, and maximizing those returns on your investment and putting them to work for you so that you can grow your real estate portfolio even further.
Excellent. And so I can add to, with respect to properties in an IRA that have debt against those properties, that's an instance where you could have unrelated business income tax, also known as unrelated debt financed income tax. So an interesting strategy that is used by some investors is to defer that unrelated business income tax, or UDFI, unrelated debt financed income tax, into a property of equal or greater value to defer the UBIT tax and then continue to compound in a tax-free environment. Now, Teresa, let's move on to, there are different types of exchanges, is my understanding. And on the website, through Equity 1031 Exchange, you talk about the 4 different types of exchanges. Could you go through the 4 types of exchanges and maybe just give a brief overview of each one and what that can mean for an individual?
So the most common type of exchange is going to be your standard delayed exchange, which is where the taxpayer is going to close on the sale first and then close on the new purchase within that 180-day time frame that they have. The second type of exchange is known as a reverse exchange. This allows the taxpayer to close on the purchase of the new property before they've actually closed on the sale of the existing property. Ideal for when you're in a market where you need to act fast on those purchases and you don't have time to wait for your existing property to sell. The third type is the simultaneous exchange, which could be either a swapping of deeds between 2 investors, or it's going to be when the taxpayer closes on the sale and the new purchase on the same day. The final type of exchange is going to be known as your improvement exchange, where the taxpayer actually closes on their sale. They're in the process of looking for their replacement property, and what they're finding are properties that are maybe not quite in the value range that it needs to be, but it needs a significant amount of work. And that type of exchange is going to allow them to use exchange proceeds to improve that property and bump up that replacement property value to where it needs to be.
Now, Teresa, let's break down the process for folks.
Okay.
So let's start with that first exchange that you referred to, the delayed exchange.
Yes.
Is that correct?
Yes.
Okay. So let's use the example of I have a property that I'm going to sell, and let's just say it's $200,000.
Okay.
And we have, let's say, $75,000 in potential capital gains. So if we apply a capital gains tax rate of 15%, or for higher income earners, 20%, plus the net investment income tax, you could be looking at anywhere between, right, maybe 20,000 or so in long-term capital gains tax.
Yeah.
In this example of a 1031 exchange, sell the first property. Let me start there. Identify another property of equal or greater value. Is that correct?
Yes, that's correct.
Now, does it have to be just one property, or could I potentially actually acquire multiple properties as long as they combine equal or greater value?
That's exactly what you want to do. Your main goal is to match value for value. So you could exchange into one property or several properties as long as you hit that 200,000 or more price range to ensure that you defer all those taxes.
Okay, so I have that $75,000 in gains. Instead of those gains coming to me, I am going to work with a qualified intermediary. Is that correct?
That's correct.
And that would be equity 1031 exchange, and that's what you do.
That's
okay.
exactly what we do.
So you would step in as the qualified intermediary, and all of the proceeds would go directly to that intermediary account. And then from there, I need to move quickly on finding a new property or new properties, correct?
That is correct.
What's the time period between when I sell and when I need to acquire the next property? Can you go through that 45 and 180-day rule for everybody?
Absolutely. These are critical deadlines, and it's really important that people understand that. So you have a total of 180 calendar days from closing on your sale to complete the exchange, meaning you need to close on all intended purchases by that 180th day or before in order to ensure that your exchange is a good exchange and you defer those taxes. 6 months, pretty easy to get something closed usually. However, within the first 45 days of that 180-day period, you're going to have to formally identify your target replacement properties. So typically what that will entail is filling out a form for equity 1031 exchange, listing your properties that you are targeting along with whatever their purchase prices are. And that is what you're going to be going after to close on and ensure that you complete your exchange. The key is only what is identified by day 45 is going to qualify for the exchange. So once you get past day 45, you're not going to be able to make changes to your list of identification. So it's critical that you get a good list going, go after that replacement property sooner versus later.
Excellent. And then that takes us to the reverse exchange. Now, this is something I learned from you, Teresa. I didn't know anything about the reverse exchange. And I was always concerned if I sell a property, but I have, let's say, another property that I want to acquire, and then something happens in the closing of that property that I'm selling, right? I mean, as real estate investors, I know this from personal purposes that, you know, you may get to the closing and then something happens at the 11th hour, right? And next thing you know, your closing is delayed by another 30 days.
Yeah.
So let's say we have an instance where we're selling a property, which you call that what again? We call that the
standard delayed exchange.
The standard delayed exchange.
Relinquished property.
Relinquished property.
Yeah.
Okay, so I got my relinquished property, the property that I'm selling. And then I have a property that I'm buying, which is called the replacement property.
Correct.
So I'm all set up to go. I'm confident that I'm going to be able to close on these two deals, and I'm going to have $75,000 in capital gains deferred. Let's say at the 11th hour that property that I'm selling, something happens and we can't close. But over here, I need to close on this replacement property. And that leads us to the reverse exchange, right?
Yes.
Where what I can actually do is say, okay, I'm going to close on this replacement property because I need to close now. Then I sell the property that I'm selling, and I can still ultimately complete the 1031 exchange and defer my capital gains. Is that correct?
That's correct.
Okay.
It's a little more involved with the reverse exchange, but that in a nutshell is what it allows you to do. Now, equity 1031 exchanges role is a little bit more involved in that type because it does require that we step in as a temporary title holder on that new purchase, but it does allow you now 180 days from closing on that new purchase to actually get your old property sold.
Now, can you give an example? I understand how many of these have you processed over the last 20 years? It has to be thousands upon thousands.
Several hundred at least. They're not as common as the standard exchange, but they're definitely beneficial in the right situation.
And then there's also a certification, right, that you hold that very few in the country hold as part of your qualified intermediary expertise. What can you describe what that is and what that means?
Yeah, so I am a CES designee, which means it's the Certified Exchange Specialist designation. There's less than 200 in the country, and really it's just a designation that solidifies that we are committed to maintaining the continuing education. We're staying on top of any changes in regulations that may impact our clients and the operation of our business. So it's something that we're very proud to have because it just gives a little bit of additional insurance to our clients that we are up to date on what's going on within this industry.
And then can you walk us through so you have the process, the 45 days and the 180 days. Mm-hmm. If someone is about to sell their property now and they engage with the title company and they sell their property, can they then go back after the fact and try to implement a qualified intermediary for the exchange? Can you walk us through what that can look like and maybe some of those pitfalls?
Yes. So I think the most important thing that people need to remember is that if you're going to do an exchange, you need to engage a qualified intermediary before you close. It's unfortunate how many times we have had to have a conversation with a client who, just as you described, went to closing, closed on the sale, check in hand or wire transfer in their account, and now they're thinking about doing an exchange. And at that point, it's too late. The opportunity is lost. So even if someone is at the closing table, they need to make sure they have a qualified intermediary in place, because once you leave the closing table, the opportunity is lost. And that can certainly mean thousands upon thousands of dollars in taxes that they didn't intend to pay. But there's no way to unfortunately go back and backtrack and fix it, so to speak, once the closing's been completed.
Excellent. And what we'll do, Teresa, is we'll put either down in the description or somewhere here, we'll put a link for all of our viewers to be able to learn more about these 1031 exchanges through Equity 1031 Exchange. And then in addition to that, how you can reach out and directly contact someone on Teresa's team. Okay, Teresa, last question is, I'm sure a lot of our viewers want to know, what are the common pitfalls so that they can stay away from those common pitfalls?
So the biggest one is going to be not setting it up in time. That hands down is the number one reason that exchanges are not successful or don't even get off the ground. The second thing is assuming that simply mentioning it to whoever you're working with, whether it be your real estate broker or your title agent or your attorney, that you would intend to do an exchange, that they're going to set it up for you. We've had a few instances where clients had mentioned it to every single party involved in the transaction, assuming that someone was going to pick up the ball and run with it and get it set up, only to find out after the fact that nobody set up the exchange. So the taxpayer needs to understand that the responsibility is theirs to get it set up, because you're the one that's going to be responsible for those taxes. So make sure that you enlist a qualified intermediary before you close on the sale. Another pitfall is not fully understanding that whoever begins the exchange is the one that needs to complete the exchange. Meaning, if your LLC is on title to the property that's being sold, then your LLC is the taxpayer exchanger completing the exchange, and that's who needs to be on the deed to the new property. We often have clients say owning property as husband and wife, and for liability purposes or for whatever reason, they want to title the new replacement property in an LLC. We understand that. However, that actually creates a separate taxpayer entity, and it disqualifies the exchange because it's violating the same taxpayer requirement. So making sure that you're keeping that consistency of taxpayer throughout the process is critical.
Excellent. We're going to publish a link where you can go directly to the Equity 1031 Exchange website. You can learn more. There's plenty of information to download there. And of course, we'd encourage you to reach out. As Teresa mentioned, one of the most common pitfalls is folks don't engage with a qualified intermediary. And know that there is a difference, right, between a qualified intermediary and someone that, is just saying that they do 1031 exchanges. So make sure you're working with a reputable company, a company that has certifications and has the foundation such as equity 1031 exchange. Thank you so much for joining us on today's program. And as always, keep leveraging compounding interest in the absence of taxation.